Now let's begin our study of currency markets. We're going to first go over a brief introduction of currency markets and then get into the market mechanics of currency pricing and trading. Trading of currencies can be confusing because we're pricing one currency in terms of another currency. So let's first review this concept of price, where price is simply a ratio of quantities. For instance, let's look at the price of a hamburger. When we usually think of the price, we just isolate that $2 there and just think of the price as being the $2. But the price is a dollar amount per some quantity of good or service, like the hamburger. So we have $2 per hamburger. Notice that's a ratio of the $2 to the hamburger. The same can be said for currencies, where the pricing of currencies is a ratio of quantities, where here we're pricing the euro in saying that the euro is worth $1.25. Now it's important to remember that when we are buying and selling currencies, that in this case we may have a price of $1.25 per euro, but when you're buying euros with dollars, let's say, like $2 per hamburger, you may buy the euro for $1.25, but that's the same as selling dollars for euros. Same thing as a hamburger. The customer may be buying the hamburger for $2, but from the restaurant's point of view, they are selling their hamburgers in exchange for $2. In other words, they are buying dollars with their hamburgers. And so if someone is buying euros for dollars, the other side of the transaction is selling euros for dollars. Now the currency markets operate as an over-the-counter market where there's no central headquarters or exchange, and it's conducted mainly through the interbank market, as we'll see here in a moment. Notice that I've got FX markets up there. The FX is just an abbreviation for foreign exchange, and sometimes I'll just use currency markets, or sometimes I'll use foreign exchange markets, or sometimes I'll just refer to it as the FX markets. So who are the major market participants? We have banks, as I said before, where the currencies are exchanged through banks. They may go through, the trades may go through FX dealers. Besides banks, banks operate as dealers, but there are also other dealers out there, and they may act as middlemen in the interbank market transactions. Obviously, individuals and companies engage in commercial and investment transactions. There are speculators and arbitrageurs, and obviously there are central banks and treasuries that engage in the currency markets. We need to realize that the currency markets operate 24 hours a day. Now you may think the same can be said for stock markets, since at any time of the day there's going to be some stock market that's open where the stocks are trading. However, a stock can only trade if it's listed on a particular exchange, and while an exchange may be open at a particular time, a stock that you want to trade may not be trading on that particular exchange, or it may have some limitations to trading on that particular exchange. However, for currencies, the currencies are traded in this interbank market between banks and other dealers, and there's always going to be a bank or a dealer that's open for business at any time of the day throughout the world. The major centers are in London, New York, and Tokyo, but there are obviously other centers that are open throughout the world, such as Sydney and Tokyo, Hong Kong and Singapore, Bahrain, Frankfurt, Zurich, and London we've already mentioned. New York, obviously, again, Chicago, and San Francisco and Los Angeles. So let's see how these markets open and close as we progress throughout the day. The highlighted blue section is the day, and the white there, the unhighlighted section, would be the nighttime. And notice that as the world turns eastward, the morning time will progress westward or to the left side of the screen. And so we have 8 a.m. Tokyo as a currency market that may be coming online. It's 3 p.m. in Los Angeles, so the Los Angeles market is up and running, and if you wanted to trade currencies, you could deal with the banks and the dealers there with Los Angeles, and looks like maybe Chicago. What time is over here in Chicago? We'll find that out later, I think, as we progress through this day. There we go. 6 p.m. in New York, 11 p.m. London. That gives us all the dates. So now let's see, as the world turns, getting ahead of myself there. We progress throughout the day. It's 5 p.m. in Tokyo. What comes online after Tokyo? Hong Kong, Singapore, Bahrain, Zurich, Frankfurt, London. It's nighttime there in New York. And then the world keeps on turning. Tokyo is closed. It's starting to get late in the day for Bahrain, middle of the day for Frankfurt, Zurich, and London. And New York is seeing the morning sunrise, getting late in the day in London, but is starting to get to the middle of the day, late morning for New York and Chicago. We keep on progressing, and late in the day for Chicago, and it's finally opening up over there in Tokyo. And we still have those centers in San Francisco. Now, let's take a look at the major currencies. Realize there are over 200 currencies in the world, but not every country has its own currency. For instance, Panama and Ecuador use the United States dollar, and every currency is not traded, or there may be limitations that exist for its trading. The major currencies, this is maybe somewhat dated, but in 2010, the major currencies would be the US dollar, the euro, the Japanese yen, and the Great Britain pound. Notice that these currencies are traded in pairs. So we have the dollar-euro pair represents 28% of the currency turnover market. The dollar-yen represents 14%, and the dollar-pound represents 9%. So out of these major currencies, we're looking at 52% of all trading turnover. The US dollar accounts for 84.9% of all transactions. These pairs, that's actually the 28, 14, and 9. Since those pairs represents 28% out of 100%, this pair represents 14% out of 100%. This pair represents 9% out of 100%, but the US dollar by itself represents 84.9% of all transactions. That would be 200%. Now, why is that? It's because of the currencies trading in pairs. So if let's say you only had two currencies in the world and you're trading dollars and euros, then US trades would account for 100% of trades, and the US dollar would account for 100% of trades, and the euro would account for 100% of the trades, because you're looking at both sides of the transaction. So you have a total of 200% there. So the US dollar would account for 84.9% of all transactions out of 200% in 2010, the euro 39.1%, the yen 19%, and the pound 12% of all transactions out of 200%. Let's look at the types of transactions. Spot transactions, which we are probably most familiar, and that is just like buying a hamburger. You go on the spot, you go to the restaurant and you buy your hamburger. Same thing for currencies. If you wanted to buy some yen or pounds, you would go to the market and buy it on the spot for immediate delivery, which takes about 2 days for it to settle, however, but you're buying it on the spot. And the 2010 daily turnover for spot transactions was $1.49 trillion. Forward transactions for future delivery accounted for $475 billion per day. And there are swap transactions, and so it's a combination of spot and forward transactions. In 2010, the daily turnover was 1.765 trillion. Again, that's 1.765 trillion per day. So this gives us a brief introduction of the currency markets. The next lecture will go into more detail on currency pricing and currency trading mechanics.